This question tests understanding of the price/earnings (PE) ratio, a widely used market valuation measure that compares a company's stock price with its earnings per share (EPS). The PE ratio indicates how much investors are willing to pay for each dollar of current earnings. A high PE often reflects expectations of future growth, while a declining PE may indicate slower growth expectations, a falling stock price, or increasing earnings relative to price. Students should analyze how changes in the numerator, market price, and denominator, EPS, affect the ratio. A drop in the PE ratio occurs when the market price falls, EPS rises while the stock price remains constant, or EPS rises faster than the stock price. The question asks which situation could explain a steady decline in the PE ratio. A. Earnings per share has been increasing while the market price of the stock has held steady. Correct. If the numerator, market price, remains unchanged while the denominator, EPS, increases, the PE ratio decreases. B. Earnings per share has been steadily decreasing. Incorrect. Lower EPS would increase the PE ratio if the stock price remained unchanged. C. The market price of the stock has been steadily rising. Incorrect. A higher stock price generally increases the PE ratio unless EPS rises even faster. D. Both earnings per share and the market price of the stock are rising. Incorrect. The PE ratio could rise, fall, or remain unchanged depending on the relative rates of increase, so this is not the best explanation. Correct answer, A. Earnings per share has been increasing while the market price of the stock has held steady. Key takeaway, the PE ratio falls when EPS increases faster than the stock price, or when the stock price remains constant while EPS rises. This indicates that investors are paying less for each dollar of earnings, making choice A the best answer. This question tests the treatment of stock splits in the calculation of basic earnings per share, EPS. A key accounting rule is that stock splits are applied retroactively when computing EPS. This means that if a stock split occurs after the reporting date but before the financial statements are issued, the weighted average number of shares for the entire reporting period must be adjusted as though the split had occurred at the beginning of the year. This ensures comparability of EPS across periods because a stock split changes only the number of shares outstanding, not the company's total earnings or total equity. In this question, original weighted average shares equals 500,000 stock split equals 241. The fact that 530,000 shares were outstanding at year-end is not relevant for this calculation because EPS uses the weighted average number of shares, adjusted for the stock split. A. 500,000. Incorrect. This ignores the required retroactive adjustment for the stock split. B. 530,000. Incorrect. This represents year-end shares before the split and is not the weighted average. C. 1 million. Correct. The weighted average shares are doubled because of the 2-4-1 stock split. 500,000 times 2 is equal to 1 million. D. 1,060,000. Incorrect. This incorrectly doubles the year-end shares instead of the weighted average shares. Correct answer, C. 1 million. Key takeaway, for EPS calculations, stock splits are treated retroactively. The weighted average shares outstanding before the split are multiplied by the split factor, so Ray should use 1 million weighted average shares when computing annual basic EPS. This question tests knowledge of the dividend yield ratio, a market-based financial ratio commonly used by investors to evaluate the cash return received from owning a share of stock. Dividend yield measures the annual dividend income relative to the current market value of the share and is particularly important for investors seeking stable income rather than capital gains. The ratio is usually expressed as a percentage. For example, if a company pays an annual dividend of $2 per share and its stock trades at $40 per share, the dividend yield is 2/40 equals 5%. Students should distinguish the dividend yield ratio from other market ratios. Price/earnings, PE ratio equals market price per share divided by earnings per share. Dividend payout ratio equals dividends per share divided by earnings per share. Recognizing the correct numerator and denominator is essential for avoiding confusion among these commonly tested ratios. A. Market price per share divided by dividends per share. Incorrect. This is the inverse of the dividend yield formula. B. Earnings per share divided by dividends per share. Incorrect. This compares earnings to dividends and is not the dividend yield ratio. C. Dividends per share divided by market price per share. Correct. This is the standard formula for the dividend yield ratio, measuring dividend income relative to the stock's market price. D. Dividends per share divided by earnings per share. Incorrect. This is the dividend payout ratio, not the dividend yield ratio. Correct answer, C. Dividends per share divided by market price per share. Key takeaway: the dividend yield ratio measures the cash return an investor receives from dividends relative to the current share price. It is calculated as dividends per share divided by market price per share and is widely used to evaluate the income-generating potential of an investment in common stock. This question tests understanding of the return on assets, ROA ratio, and the factors that can improve it. ROA measures how efficiently a company uses its assets to generate profit. An increase in ROA can result from higher net income while assets remain constant, lower average total assets while net income remains constant, or a combination of both. Students should analyze how changes in sales, expenses, and assets affect net income and the asset base. Since net income is generally sales minus expenses, ignoring taxes and other items, increasing expenses or decreasing sales reduces net income, while decreasing expenses increases net income. The question asks which scenario would increase ROA compared with the previous year. Sales decreased by the same dollar amount that expenses increased. Incorrect. Lower sales and higher expenses both reduce net income, causing ROA to decrease. B. Sales increased by the same dollar amount as expenses and total assets. Incorrect. If sales and expenses increase equally, net income is unchanged, while total assets increase, causing ROA to decline. C. Sales remained the same and expenses and total assets decreased. Correct. With sales unchanged, lower expenses increase net income. At the same time, lower total assets reduce the denominator of the ROA formula. Both effects increase ROA. D. Sales remained the same and ending inventory decreased. Incorrect. A decrease in inventory alone does not necessarily increase ROA because it may simply reflect inventory sales or write-downs without improving profitability. Correct answer, C. Sales remained the same and expenses and total assets decreased. Key takeaway: return on assets improves when net income increases and/or total assets decrease. Keeping sales constant while reducing expenses and asset investment increases operating efficiency and leads to a higher ROA, making choice C the best answer.